Good morning, traders. Welcome to the Flow Show. It's Christmas. Here we are. All got our hats on, our Santa hats on. Kate's got his reindeer t-shirt on. Merry Christmas, everybody. Morning, Kate.
Merry Christmas, everybody. Good morning, Ryan. How are you doing this morning?
Yeah, all good, mate. All good, mate. Ready to hit the holidays, I think. I'm checking out after the Flow Show. So I've got a concert tonight, football tomorrow. So, yeah, the party's starting.
You're very right.
How about you? You got your mulled wine on the stove?
Wine fridge is kind of stocked, and I'm expecting the kids from Monday, so it's going to be a pretty busy week next.
Yeah, certainly is. The Christmas tend to get busier and busier, then, don't they?
Yeah,
I've had 14 for the last 2 years, but we're going to try and have a quiet one this time around. We'll see how that works out. Anyway, right, let's get cracking. I'm going to knock my camera off for a little bit so I can concentrate on what we're doing, and maybe we'll put these back on after we got through all the news and stuff. Right, let's get shot of that. And let me get myself together. Right. Let's go. Bit of data overnight from China. They left their rates unchanged, their LPR rates at 3.1% for 1 year and 3.6% for their 5 year. So not looking to cut rates further at the moment, although it has been touted further rate cuts next year. Bit of data out of Japan, which is helping with a modicum of yen strength this morning. National CPI numbers. Now, these come after the Tokyo numbers, but still quickly following from the BOJ meeting. Nice, healthy inflationary numbers there for the whole of Japan at 2.9% for CPI versus 2.3 prior month on month, up 0.6%. The core up 2.7%, beating expectations by a pip as well. So decent numbers there. Kay, we back on for a hike?
Oh yeah, full steam ahead, mate. 0.5% hike next time.
Yeah.
I mean, we've been talking about that, Ryan. I mean, the data are supportive for to continue, right? So yeah, I think. Of course, nothing is off the table. Just again and again and again, going to depend on the speed of things and somewhere what the government instances are whispering into Ueda's ear, I think.
Yeah, I think so. But yeah, again, just like you say, it shows that the data is going the right way. And if this data isn't good enough, isn't high enough above 2% target to get them hiking, I don't know what will. But anyway, there was also the other core measure that I just missed out on, which was the fresh food and energy, which also came in high by a pip at 2.4% year on year. So it's all going the right way. It's not going quite as well as planned for the Japanese government, or the economy isn't anyway. Their latest monthly report says the economy is recovering moderately, though appears it's pausing in parts. It also cut its view on corporate profits for the first time since March 2023, which isn't that good, given all the wage gains that are going on. But perhaps we're seeing those profits hit. We mused yesterday about the lack of verbal intervention from Japan over the yen moves. Well, it looks like someone finally woke up over there. The top currency man, Mimura, said he's gravely concerned about Forex moves. Said we'll take appropriate action against excessive Forex moves and is alarmed, including over speculative moves. But then said he believes it's not appropriate to comment further on FX. Said all he needs to say, really. So some quite strong comments compared to what his predecessor Kanda used to come out with, or some of the Ministry of Finance bods and government officials there. we've obviously seen some strong moves, a lot of it driven by the US side of things, but obviously the Bank of Japan staying on hold and looking to maybe extend that hold through the early part of New Year hasn't obviously done much for yen pairs or yen strength. This is the first real high step up in verbal intervention, but I think there is a risk, particularly over the holiday period. And if we see some year-end flows pushing yen pairs higher, that there could be some intervention, purely on the reason being it's a low liquidity period we're entering. And if they want to get bang for their buck and give the market a bit of a knock, that's the perfect conditions to do so. So while usually we get a few days of verbal interventions stepping up before they tend to go, we might be a different situation given the time of year. So keep that on your radar if you're trading over the next couple of weeks. Do you think they might take that opportunity, Kay?
Okay, opportunity. It's forced, I think. But we also saw you come out of the FOMC and Bank of Japan, and we are 300 and even nearly 400 points at one stage higher. Reminds us of the famous Kuroda words where he said like 200-300 points a day starts to be excessive. And I guess that is somewhere that what they want to prevent. We also know that, as you say, the end of year market is illiquid. I'm not speculators, of course. I mean, money never sleeps. They may try, but it's perhaps a bit worried about where year-end flows could take us if what's happened in the equity markets have thrown around the picture a little bit, which seems to be the case. Yeah, I think they're worried where it could end up at the end of the year, you know. And so I think you're right. We are not safe off from interventions, especially if this goes on. It stabilize here, it may be okay, but then when have we seen the yen really stabilize over the past months or even year and a half? That you never stick at a level in the yen. It's very very rare of late. So yeah, I think they're on their toes now and they are ready to go for it. And then it all depends on what kind of intervention they do, of course. Lately, the interventions have been such that they sell in the market. They go to market and sell at various levels, try to push it lower. There's the other side saying that, okay, we are going to sit on the offer. That is another possibility, but that's not been their modus operandum of late. So the risk is there if market factors or events take this further up, definitely, and I would agree. So get another 300 points on top of it, and it may be bingo, you know.
Yeah, exactly. Yeah, my thoughts exactly. So be careful if you're trading yen over the next couple of weeks. Riksbank's Theden has confirmed that they are yet another bank who's got their eyeballs on what's coming from the US. He says they need to track Trump tariffs, and they're also worried about EU government crises as well, which is a valid point too. But as I say, another bank looking towards the US to see what's coming out of them. ECB's Patsalidis says he prefers a small gradual rate cuts, says doesn't see persistent economic stagnation or inflation undershooting, says a bigger 50 pip move would require projections showing persistent undershooting of the inflation target, doesn't see a situation where rates would need to fall below neutral. As is normal the case of ECB members, they don't see a situation until it's smacking them on the hooter. So we'll see next year whether that doesn't see turns into, oh shit, here it is. Bank of England held rates at 4.75% as expected. The vote was, in the end, a little more to the dovish side, coming in at 6.3. Was it expectations of 8.1 or 7.2, but 3 voters looking for cuts in that one. They also took down GDP forecast for Q4 down to 0 from plus 0.3. Growth was one of the worries for those cutters, but it has shown, this is what I was looking for, that there is a fight starting between whether they cut on growth or hold on sticky inflation. Bailey, in the statement, was almost hawkish. He said he can't commit to when or by how much to cut rates in 2025, and that a gradual approach to future cuts remains high. Later on during the press rounds, he said the path of rates is downwards. There's a lot of uncertainty in the world. There is no groupthink on the MPC. Can't say when particular rate cuts will take place, though he did concede that market pricing for February is in a reasonable place. He said that before, Kay, and then they haven't acted after. It's going to be interesting, the BOE next year. I keep using the analogy, they remain between that rock and hard place.
They absolutely do, Ryan, and which was also a line that I picked up from one of his radio interventions afterwards, was that it's the decisions started to be a bit on a knife edge. That's what the market took as negative in sterling as well, because we had a push through to the downside on the cable, and especially euro sterling back above 83. Yeah, it's the uncertainty, and it's quite funny if you look at it from like an outside perspective, without really digging deeper into what could be very hawkish on the one side and the FOMC, and very dovish on the or dovish, unhawkish on the other side for the Bank of England. But you got one central bank which cuts, and the other one which keeps the rate stable and widens a bit the interest rate differentials between the two, and the currencies go opposite ways. But yeah, I'm going to Harry hindsight, do a Harry hindsight perhaps here, although I said that there was a risk on what we saw in the market moves post FOMC, that some of those year-end flows may be annihilated or even reversed in a way. I think Bank of England was a little more on the edge than what we may have expected. For me, at least, I thought that they would. The vote represented that. For me, they would have stuck a little more and put that growth, Q3 growth, more in the rear view mirror. But it has been picked up, so that's a bit the negative side. And I do think a bit positioning as well. Ryan, who did the trick, could just feel that the market was probably a bit long sterling at the time as well.
Yeah, absolutely. And well, it's got another, if you people who are short cable or short a pound, got a little bit of a boost on that one. Right, we did get some data this morning from the UK, retail sales coming in on the positive side-ish. Some misses of expectations. Headline retail sales only up 0.2% from 0.5% expected. Was a gain on the prior loss last month, but not too hot. I didn't actually check to see whether this included the sales events. Obviously not Thanksgiving, but Black Friday and the like. So I'm not sure if that's included in there, but we'll take them November, December together. Core retail sales a little bit better, 0.3 versus flat expected. Some heavy borrowing figures coming in as well on top of the ones we saw last month. So the government still having to borrow, beg and steal for money at the moment. So not looking good on that front either. We've got a bit of German PPI data out as well, and some more positive prices there, 0.5% month on month versus 0.3% expected. Year on year also up 0.1%. And Germany starting to feel some inflation pressures again. They have been for a couple of months, and it's not going away, and that's not good with the state of their economy either. Back to yesterday's data, and not something I usually pay much attention to because it's so lagging its history. But the final revision of Q3 US data came in at a decent improvement of 3.1% over the 2.8 expected. That just was a bit of a cherry on the top for what we got from the FOMC and Fed regarding pausing or potential pausing of rate cuts, and the economy doing very well. So that's just fed into that a little bit and kept the dollar on the front foot as well, because there's no signs of a slowdown in the US that would prompt faster rate cuts at all. We've got the Philly Fed manufacturing index, which came in a very sucky down 16.4, was expected to erase the loss last month and post a 2.9 gain. It went further backwards. Employment still positive, but it went down two figures to 8.6 from 6.6. Prices paid rose 5 points to 31.2. Prices received fell 7 points to 7.3. So a bit of a margin differential on that one. Existing home sales came out later. They were all fine and dandy. House prices staying pretty steady around the 400,000 mark, up 4.7% from this time last year, down a couple $100 from last month, but all well and good. Banxico, they cut rates 25 pips as expected, unanimous rate decision. They say the balance of risks for the trajectory of inflation within the forecast horizon remains biased to the upside. We also had their finance minister suggesting they're going to up tariffs on certain goods, textiles, and some manufacturing products may be going up, tariffs going up to 35%, likely, as Kay mentioned, maybe to do with Chinese imports, which is something that Trump's been bashing them about, that they're an open door for Chinese goods to come through Mexico into the US. So potentially some tariffs going up on that. Mr. Trump's been busy before Christmas. He said if we don't get the debt ceiling eliminated or extended, then we're going to have a shutdown. He's backing a GOP plan to fund the government and delay the debt limit. Mr. Musk is on board with that, saying that the new proposed bill is much better. However, Democrat House Leader Jeffries says they will vote against the Republican stopgap bill, and also Biden doesn't support that either. So we've potentially got another bum fight to come. It's deadline day today, I believe. But I have seen the odd comment that a deal might get cobbled together. So expect a can kick. Do you think the market's going to pay much attention if we do get a shutdown, Kay, seeing as it will happen over the holidays?
Wouldn't Trump love anything more over Christmas? They get the Biden administration in a bit more trouble before taking office and then saving the world.
Yeah.
You know, you know who Trump's makes me think about? Chuck Norris. He's going to save he's going to crush everything and then save the world from disasters. How would Chuck Norris do it? Well, Mike is asking the question. You know, I mean, logically, Mike, a prolonged shutdown is negative. But since we already have seen many times that they can go into the 11th hour and go really to the wire, and then they usually come up with a solution. We had government shutdowns in the past, and it all depends on the length of it. If it's for a week and a half, even 2 weeks, I mean, the market knows that they are going to find a solution afterwards. But the problem is if it's a prolonged shutdown, obviously, then it could get problematic because, first of all, I mean, it's not only about government people not being paid, but it's also what they can do. And if you have a government shutdown, a prolonged one, then you start to have trouble at the Treasury as well. And that could be a case for concern. But let's first see if we're going to get one. We all know that Trump is very much wanting to cause trouble now and then solve everything later. But usually they do find a solution. And I think one little hint that they may, in the end, find a bipartisan solution is that Trump's plan, his own plan, has been voted down by a lot of Republicans themselves. So I'd say they probably find some sort of a solution, but yeah, I mean we are never safe from a temporary shutdown. That is what I have to say about it, and only time will tell, you know.
Yeah, yeah. So we may get something later today. Just keep an eye on it. I suspect we'll get the usual can kick probably early January or even February. Then Mr. Trump will be in the hot seat. Trump is also firing some broadsides across the bows of the EU, saying that they must make up for their tremendous deficit by large-scale purchases of oil and gas. That got the euro wobbling a bit this morning. But if you think about it, and we know what's been going on, it's a bit lacking a threat because the EU is already tapping the US for energy supplies since they've been diversifying away from Russia since the Ukraine crisis hit. So that has been ongoing. And if he wants them to buy more and he wants to give them a good deal, it's an easy trade to do, an easy fix for the EU, an easy solution. So which could help them out in the end if they get better prices for that energy. So it's not quite the threat that the euro saw of it this morning. Let's say that, but yeah, it's probably an easy deal to strike on that one. Before we move on to other stuff, just want to make you aware that we have an absolute bundle of expiries going off today. It's really quite a surprise. It's probably one of the biggest sets of expiries I've seen in a long time. We've got some, and I'll show you it from our chat room. We've got some 53 billion going off between 103 and 105s. 105's up there, 8.6 billion. So really some big lumps all the way through. 8.6 billion there, 8.49 there, 4.61 there, 5 billion there, 3 billion there, 3.67 billion there, 2.7 billion there. So a lot of expiries. Even in dollar yen, 157, just over 4 billion. Even euro sterling's getting in on the act. Look at those, 83, 30, 40, 2.29, 83, 0010, right where we are now, 2.84 billion. So it looks like the market has taken all the events of the last couple of weeks and everything else that's gone on and is doing its last bit of trading today, at least as far as the options are concerned, because apart from a couple next Monday, there is Zippo in the options world until the new year. So, okay, it's not often we see a big bundle like this, but
No,
we know these things tend to get condensed, don't they?
Yeah, but it's also not often that we see such a concentration of central banks in at the end of the year, right? I mean, yes, we do, but I mean, this has been a particular year where they are relatively late in the year and even into year end, and I can imagine that there's been a lot of speculative options, but also protective options being put in place by probably funds or asset managers who said like, I don't want any big accidents at the end of the year, guys, so you better protect your positions and you better protect what you need to do. So which is interesting, which brings us back to those year-end flows as well. Besides those this whole block of central banks, is that we may see that a lot more has gone through to options, which has normally a kind of smoothing effect, because if you can exercise your option. Obviously, there is going to be some kind of flow, but we also know that the sellers of options, which are most likely banks, but sometimes just the market as well, they will have managed their delta and their gamma on their books. So this may actually have a smoothing effect on year-end flows, for instance. This is what springs out to me. And so yes, it's a very big concentration, Ryan. You're right in saying we don't see this every day, but it's also perhaps not completely unexpected. And I find it quite funny that there are quite a few in euro sterling. I think that is perhaps a bit more positioning. And we also have one, and it's well, usually I don't even look at stuff which is below 2 or 3 billion, but we've got a cable right here as well. I see 2 billion there, right here where we are. It may have a bit of a smoothing effect. That's what I may think about that. And then Mike, calls or puts. I'm not sure unless you dig deeper in the details, Ryan, if you can find the balance between the calls and the puts. But if there are protection options, Mike, it doesn't matter because they will have been hedged by the time we go to expiry. You may
Yeah,
have the nearest. Sorry, Ryan. You may have the nearest one magneting a little bit, but it won't really matter whether they are calls or puts, really.
yeah. I was going to say there's several things to look at here. Firstly, we don't know who's got them and when they were put on. Some of these could be sitting there for months as a hedge for prices that were, hundreds of pips different at the time. And whether it's calls or puts doesn't necessitate what direction the market's going to move in, because as Kay said, it's not like you trading on your platform, you don't have a counterparty. You know that for every option that someone's bought, someone sold it, and vice versa. And they will be hedging that side of the trade as well. So it doesn't really matter whether they're calls or puts. Generally, everything below the market is usually tilted to puts. Everything above the market is usually tilted to calls. That's the way options usually work. Secondly, when you do have a big bundle of expiries going off like this, and people talk about the magnetism effect, and will it go to 109, 104.90, 105 because there's 8 billion up there? Not necessarily. When you have so much, it becomes a bit of a zero-sum game, because what is the market going to trade? Are they going to trade the 104.20s? Are they going to trade the 103.40s? It's too much that you could say, oh, that's going to have a say in things. If it was just one or two close to the price where we are now, then you'd say, yeah, maybe we'll do it. But we could have something, a bit of movement around 103.90, 104. We're not that far off at the moment. We're trading 93. So we might see the price glued around there. Secondly, or thirdly, or fourthly, I've lost count. We don't know who's done what, okay? Just because there's 8 billion rolling off somewhere doesn't mean it's one firm, one entity that is holding all those options. There could be 1,000 firms all taking a little pinch each. It could be 100 firms. It could be 10 firms. It could be 5 firms. So it's not a reason to say there's a big person sitting there doing something, okay? There could be a million reasons for these options being put on, and it could be done by hundreds of different entities. So are they all going to magnetize the price at the same time? Who knows? What you look for, and as I always point out, is see if the options are having an effect on the price near expiry that's out of sync with everything else. If we're glued to 104 for this 5 billion option in euro dollar, and the dollar is absolutely ripping everywhere else, cables down at 123, Aussie dollars at 61, and euro dollars sitting exactly where it is instead of dumping right into expiry, that's a potential catch-up trade, because it could mean that the expiries are keeping the price glued there, and after the expiries roll off, then the euro will catch up with everything else and see a drop. That's the sort of thing I look for, being able to try and trade these expiries. Other than that, it's good information. It shows you what people are doing. It shows you where positioning is sitting in the options market. It's part of the overall interest and information that we take from the market. So that's the way to use those. Mike, going to come back to you as well, because you were asking a question about flows and stuff.
And I'll
asking about CTAs, hedge funds, would they put their profits on short bonds, euro, longs on dollar yen? Well, first and foremost, not every CTA and hedge fund is going to be positioned the same way. Some may be short, some may be long, whatever. Ali, you've said the question, or you've said that don't expect fireworks. Big funds don't calculate their profits based on year-end closing. Not necessarily, mate, because you get some funds and the others who have run calendar years for their books. Some run fiscal years for their books. They can close off positions into the last week of the month and reopen them a couple of days into the new year. So you can't rule anything out, mate. But knowing which way they are, Mike, is a bit of folly. Just watch out for the moves. Yes, Kay, sorry, mate.
No. I was going to say exactly that, Ryan, to Ali. Don't underestimate, because quite a few have calendar end of calendar year fixing rates as their yearly rate to fix contracts for corporates, for instance, and also fixing the FX rate for conversion for FX neutral funds is always they probably changed over the years since I left banks, but to more of an average of several benchmark rates potentially, and I think that may be the case, but still a lot of them are benchmarked on the last rate of the year.
Yeah, and we've got to remember that this is a big one. You know, the monthly rebalances are, you know, pretty small, nothing to write home about. The quarterly ones are a bit bigger. The half yearlies and year ends, they're even bigger. So, you know, there's potentially a lot of rebalancing. If people have been long stocks all year, up 30+%, they may be over allocated. They've got to close up, take profit, and get their balances back on, you know, where they allocate funds. So it is a big time of the year, always is. We don't know what's going to happen. Okay, maybe nothing happens. All we have to do is know that something is possible and factor that into our trading if you're going to be trading it. Okay, if you see a wild move, judge it against the fundamentals. If it's going against what we know from the Fed, the Bank of England, the ECB or whatever, then you can probably pinpoint it as a year-end move and you can decide what you want to do with it. Okay, trading is just about being ready. Okay, it's not about something will definitely happen. It's just being ready in case it does. No one should get caught out by saying, oh, I wasn't prepared for year-end moves. We've been speaking about it enough. You should know. You should learn about it. Anyway,
yep.
let's have a look at what's going on. To be honest with all of you, as I said, I'm packing up pretty much after the flow show, so I'm not really interested in taking on anything at the moment. But I will have a quick look and then pass it over to Kay. Dollar yen got knocked off its perch up here. CPI data and those comments from Imura giving it a knock back. It's not exactly collapsing at the moment. We're back under 157, so that's something. And we're just knocking around this prior November highs that we got middle of November. So we're not coming too far below there. So really, if we get under that 156, 70, 75 area, then maybe we're going to see a bit of a steeper pullback. Wouldn't be surprised if we get down into the 155s, down to 156, something like that. If you're looking to be short, keep an eye on this 157. If we get tests that keep holding, that will be a bit of signal. But from here, it can go anywhere it wants. Euro dollar, it keeps bouncing off this little zone and these prior lows down here, but it's not getting far. We can't even get back above 104 at the moment, so it's looking very bearish still for this breakdown. We failed yesterday, couldn't quite get up there today. We keep coming down. We haven't nicked a new low below this one, so it's keeping the support in play here. and that could be quite important. But the longer we stay below this 104, then I think the bigger the risk that we're going to be heading lower. And I say that even while I'm long, although I did slash my position first thing this morning. Back above 104 is needed first. Back above 104.50, I think, would be the more positive signal that we're at least probably going back into that range. What else? What else? Yeah, go on, mate.
Ryan, on any FX dollar pair, don't forget today we also have the PCE, and combine that with what the market has been doing in equity markets of late, and combine that with those big options, could get to be a bit of a volatile afternoon today. So just be ready for those moves.
Yeah, the only thing I'd counter with that about that PC is Powell's told us the numbers. He said it's going to be 2.5 and 2.8.
Yeah, that's
and
true.
What are we expecting? We're expecting 2.5 on the PCE and 2.9 expected on the core number. So
should be around there.
Yeah, it should be around there. And if Powell's telling us the right thing as well. Euro sterling quickly. I was probably being a bit too greedy, but that's me and my discipline. I was wanting to get in lower to try and get in longs closer to the 82 figure, but we couldn't even get under 20s for the second time of asking. Now we're back above 83s. So I'd prefer to try a long down here rather than be short at the moment going into year end. But I'm going to be watching this pair closely in the early part of next year with regards to what's going to happen between the ECB and the BOE. I'm not sure which way it's going to go. If the Bank of England do have to stay on hold for longer while the ECB get to cutting, then this one's going to be a bit of a seller. But if the BOE find themselves in a bit of trouble with growth and inflation coming down faster, I think that will outweigh whatever the ECB is doing because their rates are so much more higher at the Bank of England. So this one's a bit in the mix. I'd rather be short euro dollar at the moment than short euro sterling. You still short this one, Kay?
No. Yesterday covered a little bit before, covered a little bit after the Bank of England, and then the rest at entry. I'm gone for now. So was an exercise. Didn't go according to plan because I thought we would go lower, but everything was protected. And no, I'm out for the moment. And as we were talking already a bit in our chat room, I think, and that is answering Ali's question in the meantime as well. We've been chatting a little bit about 2025, and 2025 may be a year where we're going to look more at risks for the sterling than the positives, perhaps. I mean, it is something which is worth having a thought about, I'd say.
Yeah, and keep an eye on our blog because we do have a big old post coming out where all the team are going to put forward their 2025 expectations and trade ideas and views. I'm building that at the moment, so that's going to be something for you to read over Christmas or prop your table up with, whatever your choice is. Mike, what's a quick look at Aussie dollar? It's shit, mate. I can't describe it any other way. It's looking really, really crap at the moment, as are all the Antipodeans, Kiwi as well. Can't even get up to that zone. We're just doing a bit of sideways action, but this break is looking pretty, at the moment, pretty significant. If we stay below there, then we're probably going to continue. Right, Mr. K-Man, you can have it for the last.
Yep, and it's going to be a very, very short look because there's things are on the move, but we are slowly winding down, and we are going to be trading end of year flows. So I just want to answer Ali's question about what went wrong yesterday on gold. Look, I mean, I'm not a wizard. I only look at pictures. We all look at pictures the way we want to look at pictures. But remember, I've been talking so often about this 26, 30, 35 zone in gold. Being a bit of an intermediate zone. So I did not get the reason why you would put a stop at 2026 if you're short. Your stop, in my opinion, modest, really modest opinion, because I know nothing. I'm only a market participant, but it should have been above, at least above this 26.33 here, and that I think is, if it is the constant risk that we as traders have, is if you don't put your orders, or if you put your orders in between better defined levels, you're always at risk to go and have a look, and then fail, and then go back down. You may have had a very good reason to put it there, but I don't see it. Okay, so and I've been talking about these 26.30s very, very often, and we also saw when it broke down, they went very fast. So I think you're better monitoring here this 30-35 level. Okay. What else? I think just a quickie on the cable. We dipped below the support trend line, but again, when the trend line comes to when the trend line also comes to market, I'm not really a huge fan. But look, 126, oh sorry, 124. Just in the 80s, we dipped down just below. This is your danger level for now. I just want to repeat here that be careful, because one of my supposed trades towards the end of the year was based on equity divergences that sterling could do very well. It can still happen in the last few days of the year, but those moves that we saw on the on the US indices, and I'm just taking the S&P here as an example, those moves, they can throw the year-end flows, or month-end flows at least, around quite a bit, because we are trading well below now the opening of the month in the S&P. So actually, where it was supposed to be a dollar seller at year end, it may be that this move has absolutely reversed everything. So be very careful what happens next week, and then the last couple of days of the year. I'll be off most of the time next year. I may pop up here and there on the chat room. But I'll be in on the, probably, what is it, 29, 30 or so, 31st maybe even, just to monitor the markets. So for those in the chat room, we'll be looking at those year-end flows. And what Ryan said today, guys, big concentration of option flows post the numbers just before the fixing then. And I just want to wish everybody an absolutely perfect Christmas. Just don't do anything stupid. We will still be here in the new year. Thanks very much, Ryan, for this year. I hope you enjoy the Christmas holidays, Ryan, with your family. Thank you to everybody for joining us and watching us. And from me, it is, I see you in 2025.
Yeah, thank you very much, mate. And right back at you. And thank you for the card. I've got that from you and your missus this morning. So thank you very much for that. And yeah, same to you and the family. Hope you have a good one. And to all our viewers, thank you for coming to the Flow Show all this year, sticking with us, supporting us here. It's much appreciated. We'll see you obviously in the new year. We all hope you have a happy Christmas, happy holidays, and a safe and peaceful and healthy and prosperous new year. So have a good one, everybody. And we'll see you in 2025.
Adios.
Ta-da.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.